Welcome to another episode of Money Mastery Minds. In today's economy, financial literacy is essential, especially as banking institutions are deeply integrated into our daily lives. Banks provide critical services, from safeguarding deposits to facilitating loans and credit lines. Yet, beneath the surface, there are practices and policies that often work against consumer interests, impacting their savings and financial stability. Understanding these hidden aspects can help individuals make informed decisions, avoid unnecessary costs, and better protect their money. Here, we'll unpack 7 essential truths about money that banks may prefer to keep hidden. Let's begin. 1. Hidden fees and charges that erode your savings. Many people are surprised by the amount they lose each year to hidden fees charged by their bank. While these fees are often buried in the fine print, they can have a significant impact on your finances over time. Typical charges include monthly account maintenance fees, overdraft charges, minimum balance fees, and foreign transaction fees. Sometimes, banks even impose fees for services you may not be aware of, like paper statements or ATM transactions outside their network. These seemingly minor costs add up, especially if you're unaware they exist. Consider an example where you pay a $10 monthly maintenance fee. That's $120 annually from your savings. If you regularly incur overdraft fees or use out-of-network ATMs, your total cost could be several $100s per year. Being informed and proactive can help. Review your account statements regularly to identify any recurring charges. Ask your bank about fee waivers or consider switching to a low-fee or fee-free account option. Understanding how these hidden costs operate allows you to avoid unnecessary expenses and keep more of your money. 2. Banks are businesses first and your interests may be secondary. We have to understand that banks operate to make profits, and while they provide useful services, their main objective is to increase their bottom line. This often leads them to promote products that maximize their profits, not necessarily the financial health of their customers. For example, banks may encourage consumers to open high-interest loans, sign up for premium accounts, or invest in complex financial products with fees that aren't immediately clear. Another example is loan structuring. You may qualify for a lower interest rate on a loan, but banks may offer you a product with higher interest rates or hidden fees, such as prepayment penalties. Some banks also promote credit cards with tempting perks but high fees or interest rates. These offerings may seem beneficial initially, but they can ultimately cost more over time. To protect yourself, always compare options and read the fine print before signing any financial agreement. Remember, banks may act friendly and offer a personal touch, but their primary goal is to earn revenue. Taking time to evaluate financial products based on your own needs can prevent costly mistakes and empower you to make decisions aligned with your financial well-being. 3. Inflation decreases the real value of your savings. Inflation is the gradual rise in prices over time, which erodes the purchasing power of money. This means that a dollar today buys more than it will in the future, affecting your long-term savings. If inflation averages 3% per year and your savings account yields only 0.5% annually, the real value of your savings is diminishing over time. While your balance might increase slightly due to interest, it's losing value in terms of purchasing power. This discrepancy means your money is effectively shrinking as it sits in a traditional savings account. Statistics show that most standard savings accounts fail to keep pace with inflation, which is particularly concerning for people saving for retirement or other long-term goals. Considering alternative investments with potential for higher returns can help offset inflation. Options like bonds, stocks, or index funds offer growth potential, even though they carry higher risks than a typical savings account. Being aware of inflation's impact on your savings enables you to explore diverse strategies to protect and grow your wealth over time. When you use your debit or credit card for purchases, banks charge merchants a processing fee, generally between 1 to 3% of the transaction amount. For small businesses, these fees can add up, impacting their profit margins. To offset these costs, many merchants increase prices or set minimum purchase amounts, which indirectly passes these costs to consumers. For example, a coffee shop might raise the price of a cup of coffee to cover transaction fees, which ultimately affects customers. These processing fees mean consumers might pay more without realizing it. Being aware of how transaction fees affect prices can help consumers make more informed choices about their payment methods. Choosing cash or alternative payment methods when feasible can reduce the overall cost, benefiting both consumers and small businesses. Understanding the financial dynamics at play can encourage smarter spending decisions and help you avoid hidden costs associated with card transactions. Additionally, some banks may offer lower fee cards or options, so it's worth investigating if you frequently use cards for everyday expenses. Under the fractional reserve banking system, banks keep only a fraction of deposits on hand, using the remainder for loans and investments. This practice enables banks to create loans and generate income, but also poses risks. In times of financial uncertainty, a rush of depositors withdrawing funds, called a bank run, can strain a bank's liquidity and create a financial crisis. While this system fuels economic growth by enabling lending, it also underscores why banks prioritize profit through lending and investments over keeping deposits fully available. To provide some assurance, governments generally require banks to have deposit insurance. For example, in the United States, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to a specified limit, reducing the risk for individual depositors. Understanding fractional reserve banking helps consumers appreciate both the benefits and risks associated with bank deposits. Knowing that your money doesn't simply sit idle in a vault, but is used to finance loans, it becomes easier to grasp why banks operate as they do, balancing security with their role in economic stimulation. Bankers are trained to provide a welcoming atmosphere to encourage customer loyalty and trust. This friendliness can sometimes lead customers to believe that banks prioritize their financial well-being. In reality, bankers are often incentivized to sell products that generate higher commissions or fees for the bank. For example, they might suggest opening additional accounts, purchasing certain insurance products, or signing up for services that may not align with your financial needs. Anecdotes abound of individuals who have been pressured into accepting loans or signing up for accounts with hidden fees and unfavorable terms. While banks market these offerings as beneficial, they often aim to maximize profitability. For consumers, it's important to remember that not all bank services are necessary. By researching financial products independently and asking questions about fees and benefits, you can make informed decisions that serve your needs, not just the bank's bottom line. Using your bank card while traveling can be convenient, but it often comes with foreign transaction fees, typically ranging from 1 to 3% of each purchase. These fees are levied by banks for processing payments in foreign currencies and can add up significantly over the course of a trip. For instance, if you spend $1,000 abroad and incur a 3% foreign transaction fee, that's $30 added to your expenses. To avoid these charges, consider using a credit card that waives foreign transaction fees or opting for a debit card with minimal or no international fees. Another tip is to pay in the local currency instead of opting for dynamic currency conversion, which can add additional fees. Before traveling, research your bank's policies on international transactions to avoid surprises. By being proactive and informed, you can minimize hidden costs and enjoy your travels without unnecessary financial stress. Taking time to plan your international spending helps you retain more of your money and reduce unexpected fees. Throughout this discussion, we've explored the importance of understanding banking practices for effective personal finance management. Hidden fees, profit-oriented product recommendations, inflation impacts, and even foreign transaction charges all underscore the need for vigilance in today's banking landscape. Banks are integral to financial security, offering services that help manage money, save for the future, and even grow wealth through investments. However, it's essential to recognize that banks are also businesses with a vested interest in profit. By being well informed about these 7 truths, consumers can make better financial decisions, protect their savings, and build a more secure financial future. If you found this video helpful, consider subscribing to our channel for daily insights into financial literacy and money management. Staying informed empowers us to navigate the complexities of the banking world with confidence and control. Remember to share this information with friends and family, so they, too, can benefit from these insights and make smarter financial choices. Thank you for watching. Together, let's build a community of informed consumers who can navigate banking practices wisely, avoid hidden pitfalls, and advocate for their financial health.